Are you planning to take a credit card or an unsecured personal loan? Well, things could get very expensive for you. Remember how the Reserve Bank of India recently raised the risk weight for personal loans up to 125%. What this means is that banks will now need to hold more capital before giving out personal loans to consumers. Both existing and new loans are affected by this adjustment. This would eventually result in higher rate of interest and more scrutiny by the banks and NBFCs before giving out personal loans. But why has the RBI turned cautious for such loans? After all, personal loans, if used wisely, expand prosperity, right? Well, wise utilization, it seems, is not a common phenomenon when it comes to finance. The central bank's concerns are not unfounded. Sample this. While bank credit in India grew about 15% over the past year, personal loans have grown at a pace twice that. Unsecured personal loans have increased from Rs 7.4 trillion in 2018-19 to 14.63 trillion by the end of 22-23. By the end of September 23, this amount had reached to 16.01 trillion rupees. This is record-breaking annual growth of almost 18.7% over the last 4.5 years. Credit card outstanding increased 30% year-on-year in September. Other personal loans grew 25%, consumer durable loans rose 11%. Overall, bank credit growth was 20% for the same period, showed the RBI data. Shaktikanta Das, the RBI governor, recently mentioned at a FICCI event, and I quote, "At the current juncture, there may not be any immediate cause for worry, but to remain on top of things, banks and NBFCs would be well advised to take certain precautionary measures. In certain cases, we have observed increased reliance on high-cost, short-term bulk deposits, while the tenure of loans, both and retail and corporate loans, is getting elongated. Since unsecured personal loans are given without any collateral, unregulated growth in the sector can become a big problem for India's financial sector. Even NBFCs, which give riskier loans, and microfinancial institutions, which give small loans to the lowest common denominator, raise money through capital markets and banks. The RBI is worried about the contagion effect. If a large number of people start defaulting on their loans, this could become a menace even for banks with low credit risk exposure, as the money is interlinked. This would threaten the stability of India's financial markets, currency, and above all, inflation. The RBI has cautioned against the fintech model of giving loans based on algorithms and pushed for keeping all checks and balances in place and assessing the loan repayment capacity of the individual. The central bank has been raising concerns on lending exuberance, which has destabilized the Indian banking system before, although earlier it was industrial and corporate loans. The banking regulator does not want unsecured personal loans to join the same category. Stay tuned to LiveMint for more such updates.